Good morning to all. Welcome to my channel. So today we'll discuss about the contents of financial management, one of the important part of working capital management for your MBA curriculum. So first of all, we should understand what is working capital. Working capital is nothing but the net of current assets and current liability. What is current assets? Current assets are the combination of or sum total of your debtors, stock, cash. This is the thing. What is debtors? Debtor is your to whom you have sold the material on credit, and stock is your, more particularly your finished stocks, will be converted to debtors, then come back to your cash and cash itself. On the other hand, current liabilities is the sum total of your creditors from whom you purchase the material and other things on credit, and your other liabilities for expenses for which you have to make the payment. Now question comes, your working capital management is very vital for your organization's growth. In any activity of your organizations, be it your purchasing, be it your marketing, be it your production, be it your sales, and any other activities running, even in your capital expenditure, constructions, project decisions, everywhere, this working capital management is very vital. You can see that in your balance sheet at the end of the year, some cash and bank balance is there. From there, you will not be able to understand whether your cash flows are even throughout the year. So how to know that? You have to start with some opening balance of last year balance sheet figure, cash and bank balance, that is opening balance of April for any particular year, and add with that all the receipts from your collections from debtors, direct cash sales, interest receipts, dividend receipts, all other cash receipts, whatever way it is there. So this is the thing you have to see. This sum total your all of your receipts, and all payments are your creditors payment and your raw material purchase, even your capital expenditure purchase, and after that your closing balance for that particular month. So next May month also you have to start with closing balance of April. So and April opening balance you have to same exercise, May itself also same exercise. What did it in the month of April? Receipts, total payments and balance. This way will continue all the months till coming March. After this exercise, we will understand that which of the month, whether cash balance is positive or negative. If it is negative, you have to understand that is a wrong signal for your organization. That means your payments are not matching with your receipts. The alternate other way, you have spent more than your income. So particular month there may be negative balance, and you are to making it good to the next month. And you make more analysis why this negative balance. Negative balance generally comes your non-planned capital expenditure. Suppose your capital expenditure in a particular month you are making cash, you are to see that whether your receipts are enough or not. In case your receipts are not enough, you need not make that expenditure. You understand that? Because once you are making a capital expenditure against your revenue receipts or without particular fund allocation for that capital expenditure, either in the more inflow of capital or loan capital, you should not go for your capital expenditure for that month. What will happen? If you do that way, your negative balance comes means you will not be able to meet up your regular business expenditure, because your fund comes from your operations, recovery from your sales, debtors collection, etc. So you have to plan for your expenditure. First of all, which are the urgent payments you have to make it. First, your raw material purchase payment, your staff payment, and your other statutory payments you have to make it. If your fund balance is there, then only you can go for capital expenditure. Or even if it is compulsion is there, you are to arrange for that fund either in the form of capital inductions or your loan form to make any capital purchase. So this is the very vital issue for your working capital management. You will be surprised to know that unless and until you do this exercise monthly, you will not be able to know that throughout the year what happens. And your organizations, your whether it will be cash shortage or other way. So this analysis we will be doing in some other places. Here relevant thing is there. Generally we tell that if more profit, more growth, your profit percentage is good, percentage profit on sales, profit on net worth, profit on capital employed, etc., etc. All things are good. But your working capital situation, that standard rate, that is 2:1, will not be there. And in such situations, you will not be able to meet up your organization regular liabilities. So that's why that this working capital management, this cash flow statement is very, very important. So you means that is a finance management or fund manager. His main area of operations or responsibility, how he could efficiently allocate the fund wherever the requirement. So you have to base upon your resources, you have to make a plan for that. So for that purpose, this cash flow budget also you have to do in pre-hand before actual expenditure what we have discussed. So at if you that cash flow budget, that is cash budget, if you do not do in advance, you cannot make a continuous control on that issue. Whatever you have planned for that, whatever receipts you have planned for that, accordingly payments you are making or not. So this is the vital issue, because unless and until your cash flows are not there, your organization's running will not be there. So this is the very issue of your cash flow management, rather working capital management. So today we can conclude here, and if you like this content and you think that this will be little beneficial for you, you can like it and share to your friends. I will be doing for some other video for your financial management in your MBA curriculum in the next video. So today we are ending here, and we are thanks for the day. Have a good day.